Bro, did you hear about ICT's new market maker model? Once you identify the original consolidation, your TP goes above or below that consolidation, and then you win every trade. Just because I see an original, matter of fact, I'm going to hold my trade until that original consolidation gets hit. Man, if you don't stop with that foolery, man, that's foolery. Stop that. Today I'm going to teach you guys how you are how you actually supposed to actually look into the original consolidation. And if you try to deviate from this process, you are likely to fail. I'm going to say this again. You are likely to fail because you have to understand when the probability is in your favor. Obviously, today we're going to go over a little chart work, and then we're going to get right into it. And then I'm going to show you guys what a high probability original consolidation looks like versus a low probability consolidation. And we're also going to talk about how the higher time frame draw is extremely important to understand if original consolidation is highly favorable. So, welcome back to my channel, and be ready and tune in. Peace.
So what makes an original consolidation high probability and what makes a original consolidation low probability? What are the characteristics that really distinguish the difference? And that's exactly what I'm going to try to show you guys today. Nothing more. As far as the smart money reversal and the completion of the original consolidation, those are things that I may mention, but remember that I'm going to make the next couple of videos in depth about the smart money reversal and ways that I could execute on the smart money reversal. And then I'm going to make one on the completion of the original consolidation, and basically that is going to be a separate video. So this video is really just about original consolidation. And this video is also going to go back and forth between the original consolidation and the completion of the consolidation, because if the original consolidation is high probability, that means that the return or the completion to the original consolidation is also going to happen. Most likely. It's very likely. So let's talk about original consolidations and how people don't really understand what original consolidations pick. In my opinion, there's only one original consolidation. There's not two variables. There's nothing. There's only one. And what do I mean by that? All right. This is the only way to really look at original consolidations. And this is why ICT makes it very, 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 very obvious by saying you should only focus on low resistance liquidity runs. I'm going to say this again for those who didn't catch it. Low resistance liquidity runs is the only thing that you should focus on because it makes your trading way easier. I'll explain why. All right. So, a lot of the times, let me get the path right here. We're going to have an original consolidation. Obviously, prices is chopping up. Prices chopping up. Prices chopping up. Prices chopping up. And then we have this price run here that takes out all of this liquidity right here, but we don't realize that. And then it does this, right? Does this, of course. Now we're thinking to ourselves, smart money reversal here. Buy side liquidity. That is what we are thinking to ourselves. But this is a wrong way to think. I'll explain why. If these are all highs, the house liquidity, this right here is only one thing and one thing only. This high right here is not part of the original consolidation. This high is a high that takes out liquidity. Let me say this again. It is a high that takes out liquidity, meaning that this is a stop hunt. That is the only thing it is. It is not a high, as you guys would call it. So if it's not a high, now let me rephrase myself because you're going to be like, what is he talking about? Okay, it is a high, but it's not a high that houses liquidity. So as far as me drawing up a buy side liquidity, because this is what most people do. Let me press Alt J. Let me put this line. This is the liquidity point. This is where price is going. Because this is a high. That was an original consolidation. No, you guys have to look at the information that's being provided inside the original consolidation. If this is a stop hunt, this took out the liquidity right here. So why would this house liquidity? It should not. If price goes above this high, it's because above this high there may be internal liquidity on a higher time frame, such as a SIBI, right? That is the only thing, because I mean, if it's a market maker style model, what's going to be above it is these large down candles right here. I could already see it, but I mean, obviously, I'm making you guys use your imagination, and it may be difficult to see it if you're new to it, but those who've been around for a while should understand. This is a SIBI back here. This will be like a large down candle that comes in, and let's paint that black. That's going to be a SIBI back here. So when you guys see these original consolidations, price is not coming for this high. It sounds nice, it looks attractive, but it's not a real thing, because the liquidity in this original consolidation was already taken way before the smart money reversal came. It happened here. So if this high does not house liquidity, then what would price be running for? It would be running for the SIBI. On the higher time frames, right? This is a 30-minute. Let's say on the 1 hour. This would be a SIBI. And let me just say this. Higher time frame is anything that's higher than the current time frame that you're looking at. That's all it is. Higher time frame does not mean daily, weekly. If you're on a 5-minute, 15-minute would be considered a higher time frame. If you're on a 15-minute, a 30-minute would be considered a higher time frame. If you're on the 1 hour, the 4 hour would be considered the higher time frame draw. If you could be in sync with a time frame that's higher than the one that you like to really play around with, then you have yourself a higher time frame draw. So if you like to be on the 1 hour and the 4 hour provides you higher time frame draws on liquidity, I think that's fine to me. All right. So we have the original consolidation here, but then price takes out the buy side liquidity here. This is a stop hunt. It is not a real high. Okay? Price does not go above this because of this high. It's not just buy side liquidity. It's going for the internal liquidity on a larger range on a higher time frame. Okay? ICT says focus on low resistance liquidity run. Why? Because when we have an original consolidation and price is consolidating, we just keep having higher highs like this. So what does that mean? Liquidity inside of this original consolidation was never taken. There was never a manipulation where it took out these sell stops here. Price just runs higher. Okay? So there is no stop hunt in this range or in this original consolidation. So what does that mean? That later on, it's very likely for price to come and give us this, because it's a low resistance liquidity run. Therefore, there was no stop hunt. So these lows actually house liquidity because there was no stop hunt. The liquidity was never taken, so they do house liquidity. Easy. Okay? So with that idea, let's look into actual price action. And then let's look at how price delivers to these original consolidations that do have a high resistance liquidity run. So remember, if there's a stop hunt in a original consolidation, that means that is a low probability original consolidation to target. Okay? I'm going to say that again. If there is a stop hunt inside the original consolidation. That means that that is a low probability original consolidation. I'm going to show you guys the difference in price and what price does when there is an original consolidation that is low resistance versus an original consolidation that is high resistance. Okay, probability factor changes extremely by a lot. So let's just say that for some reason you were looking at this price action right here. Okay, fair enough. You could formulate yourself a bunch of things here. You could say, this is a huge order block, or this is an order block. Doesn't matter what you have here. So price is using this order block to go lower. And then you would say, oh, look, smart money reversal, original consolidation, smart money reversal, clearing of the original consolidation. And then what people would do is do this. They would point out these lows. But then you really have to pay attention. What are these lows doing? They're taking out this low right here. And then they're snapping right back into the range. This is a stop hunt. These lows do not house liquidity because those who had those sell stops here got taken. Those who had their stop losses also here got taken. So does this house liquidity? The answer is no. It does not house liquidity. If price goes below this, it'll go below that for other reasons, not because this is sell side liquidity. It will go below this because there is an external range liquidity on the higher time frame, or there is some sort of BISI here to the left, which is basically an imbalance underneath these lows. That's it. So just picture this. We have here this bearish order block, which I would like to argue that it is not a bad idea to short this. If you're going to use this as a short-term scalp, I would say go for it. Why not? And just target short-term liquidity. Like if I were to go short here, I'd pay myself here. Why not? This is to me a mile marker. It's a place where I would consider paying myself. And then considering the range, this is also NASDAQ. You have yourself here a pretty much a 200-point move. Why wouldn't you take some off at that point? That to me is a weekly check. That is something that is worth trading. A 200-point pip scalp. Or a 200-point scalp, sorry. So, since this is the original consolidation, you clearly see what price does. This is a high resistance liquidity run. So if we go here, smart money reversal, then we try to come back down here. Look what happens. Price as is going down, it's not quick. It's an efficient price range. It's moving slow, and it's taking its precious time to come back down here. And then we have this. Price comes, stops out this low. Then we have some institutional sponsorship exactly at 8:30. This is probably some news. And then this clearly washes anybody out who got in these shorts here. And we're holding to the original consolidation. So once again, I'm going to say it again. Put your TP under the original consolidation if it's a market maker sell model, and you're going to make all the money in the world. That's not how it works. You guys have to understand the information that is being provided by these price action. Well, these price action patterns, okay? But I will say this, though. Look at this. Inside of this original consolidation, there is a lack of a stop hunt. You guys are going to be like, but look, there's a stop hunt here. There's a stop hunt here. Can't you argue that? No. You cannot argue that because this is the last high here before this price run. And this price run failed to get above this high. So what is that? A failure swing. And this is where you see the equal highs, which is why ICT points at the equal highs. This right here is very different from this up here, because here you have a stop hunt. So this does not house liquidity. Liquidity was already taken. Make sense? Obviously, you see the price action and difference. So when we were trying to, let's say we were framing a market maker sell model from here all the way down to here. This right here took a lot longer with this run right here to come down and try to go for this original consolidation or quote unquote sell side liquidity. It took a lot longer than what this did. This literally had an institutional move. You're going to argue it was the news. It was news. No. News obviously is an excuse for price to be injected. For liquidity to be injected. For volatility to be injected. It's an excuse. It's not because of the news. It is because this was the actual area in price where there was liquidity. There was an accumulation of order. There was a liquidity pool. You guys see that? A huge difference. So price goes up there in quick fashion. It does not take its time how it did with this. And it does not fail either. Now, let's just say later on, guys, right? So I'm going to do this. We already understand that this is not an original consolidation. If I point out these lows out in time, can we argue and say that these lows will be targeted because they are the original consolidation? Let's see what price does when we do get here. And let's see if we do get here, how hard is it for price to actually, ready for this, to actually get below this? And if we do get below this, at what point was liquidity created? I can tell you guys right now for this. When we took out this low right here, there was no, well, let me rephrase myself. When we took out this low here, there was liquidity. When we took it out and we formed this low right here, this little small consolidation, this does not house liquidity. It creates or houses liquidity after we have these crazy runs up here because those, think about it. If we have this large move, those who are chasing price are going to put their stops where? Down here. So that is the point where this then houses liquidity. But it does not house liquidity until there is a move present or an expansion higher. Then those who went long here, or those who are tagged in here with the buy stops, their stop losses will be down here. So their stops will be down here. So this is why this would then house liquidity. But at the moment of, it does not. I know it may sound confusing, but it's just what it is. So I'm going to have these lows drawn out in time, and we're going to see the price delivery down to this. So it takes about a week, 2 weeks, 3 weeks, 4 weeks, 6 weeks. It takes about 7 weeks for us to finally reach this low. And every time we have a smart money reversal, price keeps on playing around here. It'll go down, but it will never fully sink into this. And there may be obviously other things in there, but what I would consider this is distortion. Price is being distorted. And they're holding price for something else. Maybe a news event, a particular day in the month, and then price goes down. But as you guys could see, it pretty much was playing around a whole lot before we got down to those lows. A whole lot. It was playing a whole lot here. It was playing a whole lot here. And then obviously there was no straight down move. And then you see that if this is really, if this is truly an original consolidation, right? Then what happens? Shouldn't this really just get swept and this should be done? Well, you're going to see that the second line here, oh, sorry, I moved that. You're going to see that the second line here at 10,608, look at that. It's failing to go below that. And then prices continue to slam higher. See that? Look at this. Very important. So, sorry, let me take this off. So, this can be argued and said that this is a smart money reversal. Where's the original consolidation? It's here. But look at the information that's being provided to you here. This consolidation has a stop hunt. So it is a high resistance liquidity run. Remember that this does not house liquidity until we have large moves down, and then those who are chasing price will have their stops placed on the highs that are made, like this one, or this one, or this one, or those people who are very aggressive and have large stops will place their stops all the way above here. But necessarily, what creates a liquidity isn't this high. What creates a liquidity is the price action or the market structure around this high. Because it's not until we have these large runs down, these large runs that are going down, it's not until then that those people who enter here and are chasing price and are trying to ride the tide, they're going to place their stops here. But the one or the high that truly housed liquidity was this one right here. And then we have it stopped. And then look at price action. Boom, we take out this low right here. Then we try to go above here. And look at this. Once we break this high, it's taking its precious time. It takes about an entire week for price to officially go above and try to get into this original consolidation. So you see the delivery. And then we have, as we're reaching into this high, we have a stop on here, stop on here again. It's just very choppy. It's very choppy. It's called a delayed delivery. That's pretty much it. There's a huge difference. It's a huge difference. Okay? Now, this is the time where I'm going to say, and again, you guys are going to be like, oh, but I thought you just said this. Absolutely, but I also did say something else. I did say that if an original consolidation that is a high resistance liquidity run has above it a internal range liquidity, the reason why price goes above the original consolidation is not because there is buy side liquidity at the original consolidation. It is because there is liquidity above the original consolidation. So in this case, we zoom in here. This right here, a lot of people will consider this an original consolidation. They'll look at this from a smaller point and say, or a smaller time frame and say, oh yeah, this is original consolidation. If they look at it, if they open the chart and they just see this. And this right here is not a true way of looking at it. At least in my opinion. Once we have this here, price goes down. We have another stop hunt here. This little small consolidation goes to the drain. We have this here. Stop hunt here, then down. We have this here. Stop hunt, then down. So I would like to argue, do any of these highs have liquidity? They may, after the fact that these price moves happen after and people place their stops here. But they don't have as much liquidity. Like, let's just say all these were failure swings going into these, into this SIBI here. If all these were lower highs, lower highs, lower highs, price would have an easier time getting up there. And as you can see, the range that's going up into the SIBI is actually super lethargic. It's super slow. We have small range candles. It's not large down candles, not large up candles. You see that this entire price range or this entire delivery is slow. And it's very clear because there's a lot of resistance going into this range or into this SIBI. So it does not make sense why we just grab squares and put it over some original consolidations and say, oh, I mean, or on top of consolidations and say this is an original consolidation. It is not. It is not an original consolidation. And then this is where the higher time frame draw comes in. We have a low here. Let's see which low is lower. That's the lowest low right there. But inside of this low, there is a fair value gap right there. Let me make this color gray. So this is the reason why price is going into there. It's not because there's liquidity above these highs. Even though there is, it's not a low resistance liquidity run, in my opinion. Again, you guys may say, "Oh, ICT didn't talk about this." I truly don't care. What I'm trying to tell you guys is this is how I understand it, and it helps me understand what is high probability and low probability. It's like a way of having a filter of knowing when to participate and when not to participate, which is very important. A lot of you guys don't have that. A lot of you guys see something and you guys get in. But there must be filters or there must be a safety net. And this is one of those things that creates a safety net for you and helping you guys understand what is a high probability versus a low probability original consolidation. So what does that mean? Now, if I have these set in stone here, right? And I know that these are high resistance and all these original consolidations are low probability. Why in the world would I have my TP above them? Instead, I would be trying to capitalize off a TP that is under them. If it's a market maker buy model and there's a stop hunt in the original consolidation, I will refer to the breaker versus the highs. If it's a market maker sell model and there's a stop hunt in the original consolidation that forms or that gives you the market maker sell model, I will go or refer to the mitigation block. Well, not the mitigation block, because if it was the mitigation block, it'd be a low resistance liquidity run. But I would be referring to the breaker. And if there's a fair value gap or something like an order block near that breaker, that would be my target. So you guys have to listen to that very clearly there. Then obviously, this right here, it's fair for them to go up here, fair value, and this would create a selling opportunity. So what do? They crash price lower. And now, pay close attention. Pay close attention. This right here also is an original consolidation down here that you could target after it comes up here, right? But guess what? This also is stop hunted. Just like so. So look, right before we get there, right? And I'm pretty sure, I mean, this is the 1 hour. So let me tell you guys, most of you guys wouldn't even hold till under this low. I'll explain why. Because when we get into it, right, we return into the original consolidation. But when we get into it, you guys wouldn't weather holding this consolidation right before clearing this low. You guys couldn't weather that. Some of you guys don't have the psychology, the experience to weather that. In fact, what a lot of you would do is once you start seeing these multiple green candles form, you would look at your chart and say, oh, this is going to reverse on me. Oh, I should take my entire trade, which is fine. It's a fine thing to do. I'll tell you why it's fine. I'll tell you why it's fine to pay yourself, because if it helps you alleviate the stress of having a position on with full risk, if it helps you alleviate that stress, why wouldn't you pay yourself? It would just help you, number one, get paid, because that's what we're all here to do. We're here to make money. It would help you get paid, and number two, it will help you with your mental capital. It's not only about capital, like your money, it's also about your mental capital. And I'm going to be honest with you. If I were to go ahead and place a horizontal line, a lot of you guys, if you guys are here as a smart money reversal, you guys wouldn't be able to weather this. Hells no. You guys would not be able to weather this. This is about 2 days in a consolidation before targeting this low. And then again, why? It's because this is a high resistance liquidity run. which is why in the Orion model, I teach about the low resistance versus high resistance liquidity run. It doesn't make sense to me why you would have your TP down here and say, oh, yeah, we're going to make some money. We're going to place a TP there because some original consolidation. I'm going to win some money. It's not how it works. But look what you can do. There's a low right here, right before the external range liquidity. Why isn't it fine to just take your profits here? Full stop. Versus trying to take it below this low, where this is very low probability. Look at the consolidation. Doesn't make sense. All right. And I could continue and show you guys, millions of examples. But I don't want to make this video too long because it's very simple. And of course, I hope you guys enjoyed. I hope I was able to help some of you understand the probability factors. And I also hope that you guys use this as a filter to help you guys understand when to participate or when to stay out. And if you are going to participate, what conditional things can you put in place in order to still make money and keep your capital safe? That's the whole point. And so I hope you guys enjoyed. Have a great one, and I'll see you in the next video. Peace.